Hi there, good morning. You're watching Market Cafe and this is ET Now. Thanks so much for starting a fresh trade or week with us early in the morning. Now, this is a show where we'll take you through all the important global cues and updates that we've been tracking for you over the weekend, as well as all the things that could be big buzzers when we focus on domestic markets, like what brokerages are keeping on their radar this morning and what stocks could become potential buzzers in today's trading session. So with all of this in the bag, let's kickstart the show by looking at the global handover first. And let's start with equity markets then, Lisa, and take us through what the US markets and the European markets have done over the weekend.
Well, good morning to everyone and good morning to you, Snehi. Well, it was quite a mixed session as well as for the week for the US market. As if I look at the week, the S&P 500 advanced 0.45%, and it was the second consecutive positive week for the S&P 500. Even Dow Jones, it gained around 0.79%, but what was the outlier was the Nasdaq. It lost about 0.2% for the week. So largely it was a positive week for the indices. And this is on the back of volatility seen in the Treasury yields, the rising oil prices on the back of Israel and Hamas war. Well, if I talk about Friday, the stocks was pressured by the spike in oil prices. It saw its best day since April, and even rising inflation expectations, because the University of Michigan survey, according to that survey, the consumer sentiment, it slumped in October, and that was from 68.1 in September to 63 in October. And even the one-year outlook on inflation, even that gathered steam. It jumped to 3.8%, up from 3.2%. So on the back of inflation worries and also the rising food prices, we have seen the indices falling for the week. Now, talking about Europe, even the European stocks, it mirrored what the US stocks did. It fell, it closed lower, and this was also on the back of the US earnings which came up. The US earnings, mainly on the back of the banking earnings, it was a positive reports coming in from JP Morgan as well as Wells Fargo. And even IMF Kammer, he said that Europe will be seeing sluggish growth this year coming out of the crisis. So that's largely the handover coming in from the Europe as well as the US markets. Nehi?
Absolutely, Lisa. Thanks so much for taking us through that. Let's also take a look at what commodities have done over the weekend, and how can we not talk about oil, right? Because oil saw a very sharp surge coming in over the weekend. Prices were up 6% on the back of the Israel-Hamas conflict that is going on, and that has intensified over the weekend. But oil prices are seeing some respite now. A slight bit of a cooling off is being seen when it comes to oil prices. Now, oil prices have logged their best day since the 23rd of April on Friday. You had WTI crude oil now, which is down 0.4% at around those $87.3 dollar per barrel mark. And on the other hand, you've got Brent. Brent is also around 0.4%, but has managed to hold over that $90 per barrel mark. So Brent still above that 90 mark, and WTI crude gained more than 4% this week, posted its biggest weekly gain since the 1st of September. Now, this conflict that we are seeing on the geopolitical front has ratcheted up concerns that the fighting may affect regional energy production. The Middle East accounts for more than 1/3 of global seaborne trade. On the other hand, the IEA has sought to assuage market concerns by saying it stands ready to act to ensure markets remain adequately supplied in an event of an abrupt supply shortage. Now, the energy agency's response includes member countries releasing emergency stocks or implementing demand restraint measures. Now, also key to notice, Israel is not a major oil producer, and no major oil infra runs close to the Gaza Strip as well. But the fighting on the geopolitical front is what is causing pressure on oil prices. Now, the US on Thursday has also tightened sanctions against Russian crude exports, restricting two shipping companies that it said that has violated the G7's oil price cap, which is a mechanism designed to retain a reliable supply of Russian flows into the market while also curbing the Kremlin's war chest. So on the back of this, you've got two major geopolitical indicators. On one side, you've got the Israel-Hamas war. On the other side, you've also got US sanctioning two of Russia's major oil and gas companies. So on the back of that, well, we did see some spike up in oil prices, but they seem to have cooled down now. Brent still above that 90 mark. Also shifting focus to gold, because at a time of geopolitical uncertainty, when market instruments are expected to not do so well, investors tend to park their money in this yellow metal. So gold was at $1,934 an ounce after rallying 3% over the weekend, and gold prices have also jumped on Friday. Friday. They were poised for their best week in 7 months as the intensifying conflict in the Middle East have sent investors scurrying for this safe haven asset. On the other side, let's also take a look at some other indicators. US 10-year Treasury yield is hovering around that 4.66% mark. US dollar index is still above that 106.6 mark. On the other hand, you've got US VIX. Now, US VIX was also up 15.7%. So, well, in large indicators coming in, important numbers to watch an eye out for. But this is what oil and crude have largely done.
Well, thank you for that, Snehi. Also, let's look at what are the important events to keep a track on today. We have the global on India front, the wholesale prices will be up today, and even on the back of earnings, HDFC Bank, the Nifty company, will be in focus today. Other earnings, we have ICICI Securities, Cient, CIAT, Yatra, Federal Bank, Geo Financial Services that will be reporting their earnings today. On the corporate action front, the lock-in period ends for Utkarsh as well as EMS. Grasim Industries also will be mulling on their fundraising plans. Glenmark Life Science, it is the last day to buy the stock to be eligible for dividend. MCX will be trading today on the platform. It's their new commodity derivative platform on the web-based platform for them, and they'll be starting the trading at around 10:45 a.m. today. And on the other global event, we have the 100th anniversary of Walt Disney Company. So that's largely on the events for today.
Absolutely, and with that, let's also shift focus to some global cues and stories that we've been tracking for you over the weekend. And first of all, we are saddened to bring you a very morose update coming in from Israel. The latest on the flaring tensions on the Israel-Gaza front, the United Nations Humanitarian Office has flagged off that hospitals in Gaza will soon run out of fuel reserves within the next 24 hours. Israel has deployed thousands of troops, tanks and weaponry along the border fence with Gaza as fears of a ground invasion of Gaza grow. Israeli military forces continue carrying out raids in multiple areas in the occupied Palestinian territory of the West Bank. Dozens of Palestinians have also been reportedly arrested. Meanwhile, US officials warn that the tensions could escalate as US warships are headed to the region amid growing clashes on Israel's northern border with Lebanon. Israeli occupation of Gaza would be a big mistake, warns Joe Biden, as Israel prepares for a possible ground invasion of the Palestinian territory. Meanwhile, Pope Francis has called for humanitarian corridors to help those under siege in Gaza.
And staying with geopolitics, US as well as Israeli officials, they are discussing the possibility of a Biden visit to war-torn Israel. And sources close to the matter confirmed the news reports talking of Netanyahu's invitation for the US president. Now, the White House officials, however, they have declined to comment on the matter.
Well, in US Treasury Secretary Janet Yellen has said that the Biden administration is in fact not ruling out sanctions on Iran with respect to renewed tensions in Israel and Hamas. However, no decisions have been taken yet. Speaking at the annual IMF meeting, she widely rejected that US had relaxed some sanctions on Iranian oil sales.
Well, now shifting focus to Wall Street, JP Morgan Q3 results, it topped the estimates for profit as well as revenues. CEO of the bank, Jamie Dimon, he warned that he was concerned about the risk to the economy from rising geopolitical tensions. Meanwhile, Citigroup has reported a solid growth in both the institutional clients as well as the personal banking, fueling higher than expected revenue as well as on the EPS front.
Alright, with that, it's time to slip into a very short break on this edition of Market Cafe. But when we come back, we'll take stock of how the Asian markets have opened up this morning. So stay tuned. Hi there, welcome back. You're watching Market Cafe and this is ET Now. Let's get a move on with the show then and bring you some exclusive news this morning. Financial bids for IDBI Bank disinvestment may be called in the last quarter of this fiscal. ET Now has learned from sources that RBI is still conducting fit and proper test for its divestment. Prakash Priyadarshi is joining in with more details. Good morning, Prakash. Over to you.
Yes, we are learning from our sources that RBI is still conducting fit and proper test for IDBI Bank disinvestment. Fit and proper test for IDBI Bank's prospective bidder is still under process, and government is hoping this process to be completed by next month. So it's an important development coming in. After that, final due diligence would be initiated by the government, and interested bidders will be taken to the virtual data room when it comes to secret data of IDBI Bank. So it's an important development coming in. Sources are also saying that all factors are being taken into account before inviting financial bids for IDBI Bank, considering its complex nature of transaction. We are also given to understand that financial bid for IDBI Bank is likely to be invited during last quarter of the current financial year. So it's an important development coming in, and the government is hopeful to receive multiple bids for IDBI Bank. In fact, 4-5 companies, including Kotak Mahindra Bank, set to have submitted EOI for IDBI Bank.
Well, thank you, Prakash. That was the update coming in on IDBI Bank's disinvestment. But what's happening on the digital front? India has accelerated its digital transformation, emerging as a global startup powerhouse with over 120 unicorns and 1,000 startups valued at over $350 billion. Now, the world's intellectual property organization has actively supported this boom, launching tailored kits in 6 Indian languages to demystify the intellectual property for SMEs. Now, my colleague Samir Dixit had an exclusive conversation with Darren Tang, the DG of WIPO. Listen in.
Well, you know, India is, of course, driving towards using digitalization, digital economy, knowledge-based economy to drive its future growth. And so I think that this is reflected in India's becoming a startup nation. India now has 100,000 startups, over 120 unicorns, worth probably about 350 billion US dollars. So India already is becoming a nation that's using the power of digital to transform its society, transform the economy. And I think what WIPO wants to do is that we really want to work to support many of these startups and digital SMEs to use IP as part of their business journey. Why? Because when you talk about transforming their business models, we talk about using IT and digital, right, to grow their economy, to grow their businesses. It is so important that they use intellectual property to protect their ideas and also to bring their ideas to the market.
Okay.
So we look forward to working closely with the Indian government on that.
Okay. In addition to the startups, Mr. Darren, you are also focusing on Indian SME aspect as well, and you have got some India-specific plans as well. What is that you are looking at, and how you are actually going to or plan to execute it?
You know, WIPO's vision is to build a more inclusive global IP ecosystem.
Okay.
IP system that doesn't just support the big companies, but supports especially the small, medium enterprises.
Okay.
And so a lot of the work we're doing is how can we help the small, medium enterprises use IP as part of their business journey as well. So today, we've just launched a WIPO toolkit for small, medium enterprises in India for the first time. It'll be customized for Indian business owners. Around the world, already more than 20,000 people are using it. But in India, we hope to work with the government in India and, of course, with the business federations to bring this to Indian SMEs.
All right, moving on then, the much-awaited Indian Railways infra project, Eastern Dedicated Freight Corridor, has been completed. Commercial operations will kickstart from next month. The 1,337-kilometer project is built at a cost of 51,000 crores and will have 140 goods trains running through it. It will help the power plants in Punjab, Haryana, UP as well as Delhi, as it will facilitate the movement of coal, that too at double the existing speed.
Well, moving on, the focus will be on Tata Motors, as it is selling almost around 10% stake in the IPO-bound Tata Technologies for more than 1,600 crore rupees. Now, they will be selling it to PE firm TPG Rise Climate and an endowment trust belonging to Tata Trust chairman. And they have valued the company at a whopping 16,300 crore. And if I talk about the 9.9% stake to be exact in Tata Technologies, so 9% will be held by TPG Rise and 0.9% by Ratan Tata Endowment Fund. And with that, the equity valuation of 16,300 crore. The transaction that will be completed by 27th October. And talking about the deal quantas, the deal has been valued at 19.9 times of the EV/EBITDA basis. The remaining Tata Motors stake that is valued at around 10,700 crore. During the IPO, Tata Motors will be selling around 8.11 crore shares during the IPO, and Tata Motors will get 3,256 crore through the IPO sale. So post IPO, Tata Motors share in Tata Technologies will be around 44.8%. So with this, Tata Motors will be in focus today.
All right, so Tata Motors, to keep a close eye on that counter today. But with that, we'll slip into a very short break. You don't go anywhere. We'll be right back.
Welcome back to the show, and let's move on to IndusInd Bank that will be in focus today, as it is expected to be included in the MSCI. The flows are expected to come in on 30th November, and Somit is joining in with more details on the impact of the inflows and coming in for IndusInd Bank. Over to you, Somit.
Well, IndusInd Bank remains in focus. MSCI rebalancing is expected to be announced on November 15th early morning, and the flows related to the inclusion and exclusion will happen on November 30th. Now, why IndusInd Bank is in focus? Because fresh reports are indicating that IndusInd Bank has a high probability of getting included in the MSCI index. Now, MK has come out with this report based on the mutual fund data, and it says that in the second quarter, that is from June to September, mutual funds or DIIs, domestic institutional investors, have increased their holding by more than 1%. This is because the mutual fund data indicates that they have added more than 60 lakh shares in the second quarter of FY24. Now, most of this increase would have happened owing to FI selling that we had seen as per MK, and this means that FI holding in IndusInd Bank would have come down to around 40.8% from 42.3% that we had seen at the end of the June quarter in 2023. Now, because of this fall in FII holding, the available foreign limit or foreign room must have increased to around 15.9% from 13.9% that we had seen at the end of the first quarter, and this makes the stock, that is IndusInd Bank, eligible to get included in the MSCI index with an adjustment factor of around 0.5 times, something similar to what we had seen for HDFC Bank. Now, on the back of this, MK is expecting there could be inflows of close to 250 to 300 million US dollars in IndusInd Bank, and this is nearly 5.5 times its 20-day average volume. Now, the shareholding pattern data is expected to come out anytime this week, because last time the company had disclosed the Q2 holding in October 18th, and this time anytime soon the September holding is expected to come out, based on which IndusInd Bank's eligibility to get included in the MSCI index would be decided. To keep an eye out for IndusInd Bank in trade.
All right, Samit, thanks so much for taking us through that. IndusInd Bank will be in focus on the back of that news flow. Moving on then, let's look at quarter two earnings, and it was a muted quarter two for Avenue Supermarts, or D-Mart as we popularly know it. PAT and margins have fallen despite the revenue jump of over 18% on a year-on-year basis. Now, what has hurt the quarter gone by, and what are the brokerages saying? Winnie is joining in with exactly those details. Good morning, Winnie. Take it away.
Morning, and a weak set of numbers is what we could say is reported by Avenue Supermart. Revenue, yes, that came in line, because obviously we have a fair idea of what to expect in terms of revenue, and that growth momentum continued in revenue because there is a slight bit of a recovery coming in the sales of apparels as well as general merchandise business. But other than that, profits was a miss. Margins was a miss coming in from the company as well. When you look at the profits, they were down by 9.7%. EBITDA also, the performance, operating performance seems to be a bit weak as well, because margins have seen a contraction of around 50 basis points as well. 8.1% is what the EBITDA margins came in versus an 8.6%. Higher other expenses is something that is dragging the bottom line of the company. Margins were lower due to the adverse sales mix as well. That's the commentary even that came in from the management as well, that the gross margins of the company were seeing a decline because the sales mix has changed, and still the high margin business, that is the apparels and general merchandise business, has not still seen a recovery as they were expecting. So clearly a below set of numbers, a weak set of numbers that has come in from the company. Jeffries now is maintaining and hold, though they have hiked the target price on Avenue Supermart to 3,850 rupees from previous 3,700 rupees. They too are highlighting that the EBITDA was a miss on even from the Jeffries point of view as well as the street point of few. General merchandise apparel business, like I mentioned, has remained muted, which is causing a pressure on the margins. And the first half for the company in terms of the same-store sales growth, that has come in at 8.6%. This is an inferred number according to Jefferies. So let's keep an eye out on overall how this actually shapes up for the company going forward. But as of now, a weak set of numbers reported by Avenue Supermart.
So Avenue Supermart will be in focus on back of its muted earnings. But Vinny, stay with us. That was on Avenue Supermart. What are the other stocks that are on brokerage radar? We have reports coming in from CLSA, Morgan Stanley as well.
Absolutely. A lot of reports that have been coming in this morning. First, let's talk about Paytm. We have a report that is coming from Goldman Sachs where they are maintaining a buy on the stock, hike the target price to 1,250 rupees per share. Previous target price was 1,200 rupees per share. They believe that Paytm's operating matrix is something that has been improving. So the operating side of the performance of the company has started seeing an improvement. That is why they are raising their FY24 to FY26 EBITDA estimates by 2 to 5%. They expect Paytm to actually be the most profitable company within the India internet space, as well as they see the company turning income positive in FY25, which will be a good catalyst for the stock going forward as well. So let's keep an eye out on Paytm on the back of this. Now, Morgan Stanley has come out with a note on Infosys. They're maintaining an overweight rating, target price of 1,600 rupees per share. They believe that Infosys share price will rise relative to the country's index over the next 60 days. Infosys is trading at a discount of 14% to TCS. So that is something that will benefit maybe Infosys, and that could lead to an up move given that it is still trading at a discount to TCS as well. They believe Infosys is well positioned to see a strong revenue growth in FY25. Margin improvement also is something that they are watching out for, and risk reward for Infosys is favorable. So that is why they're maintaining an overweight rating on Infosys. While in terms of Morgan Stanley on TCS, they're maintaining equal weight rating, target price at 3,590 rupees per share. They believe TCS, on the other hand, will actually see a fall coming in compared to the country's index in the next 60 days. Strong order inflows has not translated into an uptick in the revenue growth due to leakages. So that's a concern that they are highlighting. And also the risk reward, according to Morgan Stanley, for TCS is not favorable because it had outperformed in the last 45 days. So maybe a downtick is what they're expecting for TCS. Lastly, ICICI Prudential Life, that is in focus as well. And the back of a note that is coming from CLSA, they're maintaining a buy, target price of 700 rupees per share. They believe ICICI Bank channel current run rate implies a positive growth for October and onwards. Non-banking ICICI Bank channel has a potential drag from the high-ticket policies as well, I believe, and they believe the outlook today is far better. So that is why they're maintaining a buy rating on ICICI Prudential Life.
All right, thanks Vinny for taking us through a slew of brokerages that we've had early this morning. But also let's focus in on another counter on the back of its quarter two numbers, and that has to be Dalmia Bharat. Now I'm joined in the studio by Ashesha. Ashesha, the margins have come better, costs have gone lower. So give us a snapshot of what the earnings for Dalmia Bharat have been.
Well, yes, largely inline set of numbers for Dalmia Bharat. Volumes have declined, but margins have positively surprised. They've come in much better than what the street was working with, and brokerages are also quite positive on this counter. First up, let's take you through the numbers, where operating income has come in at 3,150 crores, which on a year-on-year basis is an uptick of about 6%, while EBITDA has seen a solid growth of 55% on a year-on-year basis. Volumes have, as I mentioned, are below what the street was working with. On a year-on-year basis, it is up 6.7%, but below what the street was working with. EBITDA growth, yes, it is on account of lower fuel costs that the company experienced in the quarter gone by, and it is also on account of lower cost of renewable power. In fact, power and fuel costs declined by 12% sequentially and 27% on a year-on-year basis, and that's what aided margins for the company in the quarter gone by. Net debt, meanwhile, has risen from 1,200 crores at the end of last quarter. It has risen to 1,500 crores, so that's a bit of a negative. In fact, the company has also undertaken capacity expansion in the quarter gone by. Cement capacity has now risen to 43.7 million tons, with clinker capacity now standing at about 22.2 million tons. Remember, the company has undertaken aggressive capacity expansion over the last few quarters. In fact, over the last few years, the company said that they've added 17.2 million ton cement capacity in the last 3.5 years, which is an increase of about 65% over its FY20 capacity. Numbers largely in line, but as I mentioned, brokerages are quite positive. Analysts say that second quarter suggests company is attempting to realign its volume push strategy with profitability, and second quarter is just the beginning of change for better. So brokerages are quite positive, but numbers, as I mentioned, largely in line. Margins have seen a solid improvement this quarter.
Well, thank you, Ashesha, for taking us through that. So, Dalmia Bharat will be in focus on the back of an inline set of numbers. But, Ashesha, what are the other stocks that we have to keep an eye on according to you?
Well, yes, a whole host of counters in focus on the back of its results. First up, let's talk about Texmaco Rail. Very strong set of numbers from this counter as well. Revenues have seen an uptick of about 66% on a year-on-year basis. Margins, meanwhile, have also expanded. They've come in at 9.6% versus 8.9% that the company reported same time last year. So on a year-on-year basis, 70 basis point margin expansion. Strong set of numbers, but the company has also approved demerger of its infra, rail and green energy arm. It contributed about 30% of its consolidated revenue. So along with its results on the back of its demerger news, this counter will be in focus today. Let's also talk about Som Distilleries. This one also in focus on the back of its strong set of results, where revenues have seen an uptick of 70%. Margins, meanwhile, have contracted a tad bit. They've come in at 11% versus 11.8% that the company reported same time last year. But remember, this has been a strong performer. It has been a wealth creator, and yet again it has reported very strong set of numbers. Gati, meanwhile, has reported operating data for the month gone by. So for the month of September, volumes have come in at 109 KT, which is an uptick of 8% on a year-on-year basis, although they've declined marginally by 3% on a month-on-month basis. And for the quarter gone by as well, on the back of strong festive demand, volumes have seen a solid uptick. Meanwhile, also keep an eye out on Utkarsh Small Finance Bank and EMS, and that is because lock-in for both of these counters ends. About 4% equity of Utkarsh Small Finance Bank, which was locked in, will now be open. Perhaps some selling pressure will be seen on this counter. Grasim Industries, meanwhile, the board of directors will be meeting today to consider fundraising plans. And lastly, Delta Corp. This was in focus on Friday as well on account of its results. And now the company has received GST demand from Directorate General of Kolkata. And the GST demand stands at about 6,384 crores, and this is for the period July 2017 to November 2022. Big negative coming in, and hence Delta Corp will also be in focus.
Alright, a bunch of counters to really keep on your radar today. Thanks, Ashesha, so much for taking us through that. Let's also shift focus and talk about HDFC Bank, because this banking giant is geared up to declare its Q2 numbers today. Key to note that this is the first earnings season for the bank post its merger with HDFC Limited. Now, what is the street penciling in when it comes to this banking major, and what are the factors that you must keep an eye out for? Harsh is joining in with what to expect.
Right, HDFC Bank will kick off earnings for the banking pack Q2 FY24. It's going to be a unique one because HDFC Bank is now a merged entity, HDFC Limited plus HDFC Bank, both loan books combined, and therefore the numbers will appear combined, and the percentages therefore may not be comparable versus last year or last quarter. So let me start off first with that net interest income number expected around the 28,500 odd crore mark. That's where it's expected. Where operating profit is concerned, around 23,000 crores. So we're expecting quite an elevated OPEX this time around as well from HDFC Bank as they continue to invest in branches. Let's talk about provisions expected around 3,100 crore. Now, mind you, provisions last quarter were around that 2,850 odd crore mark. So you add up the HDFC Limited provisions and roughly you're arriving at a 3,200 crore number. That's where we are getting the number from, and profit after tax is around the 15,000 crore mark is the expectation. 14,800 is the number as per our poll. Of course, the most important piece of the numbers will be how net interest margins are evolving. NIMs are expected to retreat a fair bit. In fact, the overall NIM, which was at 4.1% in Q1, is expected to be around the 3.7% number. That's the guidance. Of course, need to wait and watch out how it actually plays out. The other piece or the monitorables will be with regard to how ROAs are going to move and how quickly can they move to that 2% number, and whether that loan growth of 6%, 5% odd sequentially is really sustainable. Of course, deposit growth also very solid from HDFC Bank. Whether those numbers are sustainable or not is going to be the key with regard to where management commentary is concerned.
Well, thank you, Harsh, for sharing your perspective on what to expect from HDFC Bank that will be reporting their earnings. But now shifting focus, the word is coming in that government is in no mood to crowd out the market with a flurry of OFS. And ET now has learned from sources that the Department of Investment as well as Public Asset Management, the DIPAM, wants sufficient gaps between the OFS to create the appetite and wealth for retail investors. And Prakash Priyadarshi has more details on this. Joining in is Prakash. Over to you.
Yes, we are learning from our sources that the government is not in favor of crowding out market with flurry of OFAs. In fact, DIPAM wants PSUs to become more efficient and improve their profitability. Sources are saying that it wants PSU companies to focus on transparency and accountability in order to protect investors' interest. When it comes to more OFAs during current financial year, we are given to understand that the government is looking at appropriate timing and better appetite in the market before coming out with new set of OFAs. So it's an important development coming in. What we also understand is that it will take sufficient gap between OFAs of some PSUs companies. The government is of the view that deeply discounted OFS is not going to serve the purpose. Therefore, calibrated approach will be adopted, which means better valuation and wealth creation in PSUs are major factors being considered at this point of time. Government sources are also saying that Coal India Limited OFS has done pretty well due to calibrated approach the government has taken, and it will continue further. However, we are also given to understand that there is a possibility that the government may launch OFS in some companies, including Hindustan Zinc Limited. But the timing is very crucial, which is not decided, especially considering the fact that calibrated approach that the sources are talking about. But the one thing is pretty clear that the government seems to be in no hurry.
All right, Prakash, thanks so much for all of those exclusive details. Let's move on then and listen in to the market voice, Ajay Srivastav, who's the CEO of Dimensions Corporate Finance Services. He shares his outlook on realty, auto, as well as a slew of sectors and his stance on them. So listen in to what he has to say.
Realty stocks have a two-way component. One, of course, is, I'm going to tell you a joke about this one of the largest real estate companies, MD told me that, and they have a garment business as well, that it's easier to sell a 2 crore house than a 20,000 rupee jacket in this country. And which tells you the story right now, that there is a frenzy out there in the market. And when you buy into a frenzy, you will pay for it. And I think people who are buying real estate today, or you buying into real estate company, except, and I'll come back to that, are not going to get the best possible return. You can get a short-term return, but definitely not from this way, because you're buying a real estate company at the land rates of today, hoping that you will make a 20% plus return on your portfolio in the next 5 years. Now that takes it, the property prices need to double really to give you that kind of return. I don't think that's going to happen at all. Unless you have something like a company like a North Indian Diversified Company, which has got rental yields coming into the portfolio in a significant way. I think those are the ones which will gain in the end because annuity income comes in. Unlike a pure play company which are standalone, that they sell the houses and they book the profit and they go away. So I would rather bet on real estate where there are good annuity incomes from commercial and properties coming, office properties, than just pure play, just the housing kind of company. So pick your choice, but it's going to be very difficult for real estate companies to beat the market returns in the next 3 years from where they stand today.
Okay, fair enough. That's your take on the entire real estate space, and autos really have been in top gear. Ajay, what's your outlook? They're talking about how the premium end as well is doing very well. What's the expectation when it comes to the festive season? Would this be a good space to bet on?
Oh, of course, it's going to be a good season. I think, India's upper tier consumption story is absolutely intact. It's the lower end 70%, which is a problem. The top 5% doing well. I live in the same complex you mentioned, the Camellias, which is prices are going berserk. There is no barrage on buying stupid. That's in the world. A lot of people, money is lost. You saw SoftBank, right? Buying atrocious prices, but that's okay. Somebody's got too much of money, doesn't care about 100 crores. That's fine with that. But the point still remains that the upper tier of India is earning well. The wealth is increasing at this point of time. And just remember one thing. The reason upper tier is doing well is that we got a big tax cut in this corporate market, which became 25%. So while I pay a 42% tax, a company earning 5,000 crore only pays 25% tax. Now, all that benefit of tax has now gone to the promoters and the HNI and to the corporate market, stock market as well. So remember this, and now if you set up a new company, the tax rate is 15% for manufacturing companies compared to 42% individual income. So upper tier business families, industrial families, stock market owners are all gaining at this point of time. No reason for upper tier consumption story. 5-star hotels, you've seen what's happening there. Travel, you've seen what's happening there. You've seen the remittances abroad going absolutely skyrocketing. So upper tier India, perfect shape, will going to spend money, and there's no problem at all. If you're betting on the economy end, I think that's where the problem is and the pain is.
Quite interesting. Ajay, what do you then do within the rest of the market? I mean, what is it that you actually avoid at this point? Anywhere you feel that the valuations are exuberant and have run up ahead of the fundamentals?
No, I think we just need to keep away from chemicals for the time being. I think they're too overpriced given the market conditions. That's some sector we're not going to be in. I think we are almost out of pharmaceutical at this point of time. The run-up, pharmaceutical run-up happens actually once in 5 years, and that run-up has already happened. I think by and large, the story has played out for a superior return. And remember this, our threshold also has gone up, because if I'm getting 9% or 12% in fixed income with almost negligible risk, I need to find stocks to give me 18% plus return in the next 3 years. Therefore, I don't see chemicals as a story which will give me that kind of return. I don't think pharma is a story which is going. We have returning back to little bit on the banking space, not the NBFC, but banking space. I think we're going to be there right now. Capital goods, fantastic story. Don't worry about it. Defense, lovely story, because there is no supply of stock coming there. There's more demand of stock. And I think, if I'm not wrong, one mutual fund has it that you can't buy bulk, a defense sectoral fund. You can only buy an.
Well, congrats to India for the big win against Pakistan. But with that, it's a wrap on this edition of Market Cafe. But stay tuned on the channel as we catch all the action on the market.